This strategy is gonna make you profit even in downturn, right? In the market the way it is going right now, it's very difficult to make profit, right? And even with less capital. So this strategy does you both. It takes less capital and it maximizes your profit and it limits your risks. So we are going to discuss that strategy in this video. I'll explain all the details, what the stock fundamentals that I see and how to execute it properly, how to manage your risks. So all that we are going to discuss. If you are interested, then please stick around, and with that, let's start. Hello guys, so welcome to AD Finance, and today we are going to discuss one very important option strategy that's called call rate spread. It's also called bear call spread. So the name bear right in this, that kind of signifies that why it is called a bear call spread, because this strategy works best in a bear market, right? And that's how we are seeing right now. There's not much momentum. It is kind of definitely not a bull market that we saw in last couple of, at least for the whole year last year and till Feb, right? It was a complete bull run, but that has stopped now. Now we are almost in a bear market territory, and there are very few strategies now that can make you money, and this is one of them, right? Now this strategy, right, this is a very good strategy for number of reasons, right? First of all, it makes you the amount that you need for this strategy to work is very less. It has very less risk and it requires a very less capital, right? So that makes this strategy very wonderful, in especially in this kind of environment. Okay, in terms of executing this strategy, this would take you two legs and execution. I'm gonna give you an example with a good detail, but just a general gist, right? This basically requires you two legs. So you basically sell a call at a strike price and then you buy back that call at a upper strike price, right? So that basically makes a complete call rate spread or bear call spread, as and both terms are kind of used interchangeably. So anything is the same thing. If you hear the term bear call spread or call rate spread, they are all same thing. They requires these two legs, and I'm gonna explain you in detail with an example, so that will make it super clear and you would understand how this works, right? So with that, let's go to my screen and actually see the stock that I've chosen for it and why I did that, and then I'll explain you step by step how to execute in the Robinhood platform. Okay, so I'm in my Robinhood screen, and the stock that I've selected in this for this strategy is Tesla, because if you look at the Tesla, right, it has kind of lost the momentum, and it's trying very hard to break this level, but it cannot break that level, right? This is if you look at here, right, this kind of went to like almost almost 500 level, and then it came down right here at 310, but it is not able to break that level. Even if you look at, right, 386, 3929, sorry, 286 and 290 level, it's finding it very hard to break that level. So if you look at here, this 310 is kind of just to make it more safer. I will go with 310, right? So if you know, right, the previous whatever was the support, right, that becomes the resistance. So in this case, this is kind of because it has found kind of a good resistance here, right? So that's what we are gonna use it. It's like if you look at it's bounced back here, and it tried to break past this, but it could not break it, and it again fell down, right? So that's how it in this territory. So even if it goes up, it's gonna find it very hard to break above this, right? So the one key for this strategy is to find a strike price, a good resistance, right? Because if you find this wrong, then your strategy may go against you. So it's very important that you analyze at least a minimum support and resistance line and a good long-term support. So this chart is a daily chart on a yearly basis. So this resistance is a very strong resistance, and that's what we are gonna choose as a strike price. Now to the strategy, right? So if I go to my uh, Robinhood account, and this is let's start from the Tesla, right? So if you go to Tesla, you basically click on trade Tesla options. So that's what you're gonna click. It's gonna open the option chain, and for expiry I'm gonna go at least give some time, so that you get good premium, right? So I'm going to select June 20th in this case. And the first thing that you do is you gonna basically sell a call, right? So that's the first leg that I explained, right? It's kind of combination of two legs. So this is the first leg, sell call, and that you do on that strike price that we discussed, right? You do sell that call at this level, okay? And the next leg you buy the call at just a leg above, right? So you buy this call, so that becomes your second leg, and you should see it here as a call credit spread, right? So that basically makes it a call credit spread. And if you look at the profit and loss graph, right, if you see here, you can easily get $70 for it, because that's the middle ground here. So the bid and ask, right, if you want to get it fill too quickly, you can select bid, but I am very sure you can find some middle ground here, which is around 65 to $70 you will definitely get in this trade. So I'm just giving like 70. So the profit loss, right, on this, you can see here, right, your max loss in this case is 430, and your max profit is 70, right? So in return of your investment, it's very good. So why it is and the collateral, right, and the collateral you would need is 500, because the strike price difference multiplied by 100, that becomes your the collateral you need, right? And you are already collecting this credit right away. So as soon as you execute this, you're gonna collect this. And by June 20th, as I explained right here, it's finding it very hard to break that. So it's very unlikely that it's gonna break that level. And as long as Tesla stays below that level, you're gonna keep this complete $70. So that's gonna be your profit. So this is the strategy, and to execute it, you just do review order. You check what I explained, right? It says collateral. There are two legs here. The one is sell to open and you do buy to open. So those are two legs, and you then submit, right? So that is how you execute this strategy in Robinhood. Okay, and this is a wonderful strategy. And the couple of things that I told you to remember this is always manage your risk properly, because and to do that, your entry point should be good. Your strike price selection should be very accurate, and it doesn't require much capital. So that's the beauty of it. If you have good capital, what you can do is you can increase the number of contracts. You can go from one to, let's say, five contracts, right? That makes your profit big. So you're gonna make almost $350 profit on this trade, right? It does increases your collateral too. But even if you see, like, instead of owning this stock outright, this capital requirement is very less. So that's again a good point of this strategy. So keeping all those things in mind, use this strategy in this market, not just with this stock. You can apply the same thing in any other stock. This is the one stock that I have found based on my research, because finding it very hard to break that level. So you can definitely execute this one or any other stock of your choice, right? If you just remember these key things. So that was it, guys, for this video. I have a lot of other videos. I will put some video links in my description. Definitely check them out. They are related to options. If you have any questions related to this strategy or any other strategy, do put your questions down in the comment below and I will reply to that. So that was it, guys, for this video. I'll talk to you in my next video. Till then, happy investing. Bye bye.